Average minimum debt payments are rising. What if it happens to you? What do you do? And how do you avoid bigger debt trouble? Maureen is here and we're going to discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
In TransUnion's Q4 2022 report, shows off to a good start. I've already butchered the date here. Which is the most recent data we've got. They highlighted that higher interest rates and higher credit balances have led to higher minimum payments. Okay, that makes sense. In fact, TransUnion states that the average credit consumer with a balance saw a 10% year-over-year increase in their minimum monthly payments. That sounds worrisome. Maureen Parent is here. Maureen, how are you doing today?
Hi, not too bad, thanks.
I know you're recovering from the seasonal cold that afflicts all Canadians between the months of November and the end of April. So fortunately, the spring will be here eventually, and it will all go away. So okay, let's talk about this and figure out what this all means here, because it doesn't sound good. And we'll see if we can put up a graphic on the screen here that shows some of these numbers. So the average minimum monthly payment required was $102 on a credit card, $411 on a line of credit, and just under $2,000 on a mortgage. Okay, that kind of makes sense. But what's interesting is that the year-over-year increase in those amounts was over 9% for a credit card, 35% for a line of credit, and about 17% for a mortgage. And again, this is numbers we're getting from TransUnion. And I think it's kind of obvious why line of credit payments would have gone up so much, because interest rates went up. Interest rates go up. That's obviously going to make your payments go up as well. So, okay, let's delve into this a bit. And again, it's Maureen. Did I introduce Maureen already? Yes, I did. So
yes, you did.
Coming to us from beautiful Canada in the Ottawa region, Maureen is our trustee in charge of the Ottawa region. So why is it that minimum payments go up? Walk me through the thought process. I mean, is it as simple as, interest rates went up, so minimum payments went up, or is there more to it than that?
There's a bit more to it. Every lender has its own terms and way of calculating like what minimum payments are. But generally your payments go up because you're charging more to your credit card. So there's a higher outstanding balance. Therefore, there's more to pay. You're not paying down the balance. Another reason would be fees, right? So there can be an annual fee that always comes on at the most inopportune time. And then there's late payment fees, like if you miss payments. There's also the changes in credit card terms. So the interest rate can increase, as already mentioned, but there could also be an increase in the minimum payment percentage, which could seriously impact your budget.
Well, you've hit on a couple of key points here then. So you're right. It's not as obvious as I said, interest rates go up, they go up. So one thing is special fees. So if you're like 2 days late on your payment, sorry, we're charging you X number of dollars. If you're over
and your interest rate goes up.
Well, so it's the double whammy. So here we're whacking you, $30 because your payment was late, and then we're going to whack you $50 because your payment bounced, and then by the way, your interest rate's now higher because we think you're a higher risk. So those are all huge problems, obviously. And then this whole changing of the terms thing, because a credit card is a revolving debt, meaning it can go up and down, but it also means the lender can change the rules anytime they want.
Yeah.
That's what it means, right? So they can say, this month the interest rate has gone up to this. And they can say, okay, now we've changed whatever the terms are, they can change them. And obviously when those things change, that will affect what your minimum payment is going to be.
I find the minimum payment increase interesting because it is intended to help people pay off their balance faster. So it's intended as a help. But if your budget is already tight, that increase will make it significantly harder. And then on top of that, the interest rate has increased, which also may not affect your minimum balance payment, but it does affect how long it takes you to pay things off. So it's
okay. Well, let's talk about these minimum payments then. So, because you, again, have hit on some pretty good points here. It's supposed to help you. okay, I will take the alternate viewpoint and say, no, it's the exact opposite. It's supposed to keep you in debt is what it's supposed to do. Back in the old days, there used to be something called a charge card. And I think American Express, when it first started, was a charge card. You're not old enough to remember this because you're just a young whippersnapper. But I'm pretty sure the first American Express card I had, which was probably in the 1980s when I started at the big accounting firm and they gave you the card in case you had to travel or something, it had to be paid in full every month. There was no such thing as a minimum payment or anything like that. It was paid in full every month. Well, now, of course, no. All you have to do is make your minimum payment. And your minimum payment is something like the interest plus a small number, 1%, 3%, something like that, right? So if you're carrying a $1,000 balance, the minimum payment may only be $50 or $100 or something like that. So what is the problem with minimum payments other than what I just said, which is I think it's a way to keep you in debt forever? Tell me the bad side of minimum payments.
Right. Well, with the minimum payment, it's not moving the balance or barely moves the balance. It's imperceptible. And some people, when you're at the top end of your limit, a minimum balance doesn't necessarily keep you from going over the limit and having over limit charges as well because of the next interest cycle, right? It's also tempting to just pay your minimum payments. Things get sketchy and you're like, okay, well, I can afford life if I make this minimum payment and everyone's happy because I'm no one's calling, right? So it gives us that sense of reprieve that we're looking for. And it also keeps your credit score looking pretty good. And oftentimes people feel that if their credit score is good, then they must be financially secure and stable, which is a false sense of security.
Didn't I write a book about that at some point? I think I did.
So, yeah.
And I think I made that point that your credit score is something for the benefit of the lenders. It's not for your benefit. That's not what it's there for. And so, yes, if you do exactly what you just described, I pay my minimum balances every month, my credit score is going to look great. Yeah. But it's not really great because I'm paying all that interest. That's just not a good thing. And you, as you said, it barely moves the balance. In fact, it may not be hardly moving it at all because, of course, they're just going to whack you with interest again next month. So, again, I reiterate my point. I think if what you're doing is paying the minimum payments, you will be in debt forever. And that's not mathematically true, but that's pretty close to true.
Credit card statements, it'll say if you make your minimum payment, this $5,000 is going to take you 90 years to pay off.
Yep.
And I don't have 90 years left on this earth.
Well, I do. I'm much younger than you. But yeah, you're right. And our clients bring those in all the time. And we go, yeah, look, I've seen them over 100 years. So I don't know mathematically how that's even possible, but okay.
And then if you look at it, you've paid your debt at least 4 or 5 times over as well. Yeah. Right. So
yeah, and I think we would all be better off looking at the total we're paying rather than focusing on the minimum payment. Because you're right. I look at it and go, okay, my minimum payment's $100. I can afford $100. It's all great. Well, no. That thing you bought for $1,000 is going to end up costing you $2,000 or $3,000. It's not the minimum payment that's really relevant. It's the total that you're paying. So we got to focus on that. Okay, so
and will that $1,000 thing still be in your possession and working? After you've paid it off.
Yes,
right?
I mean, I guess if you spent the $1,000 on crypto, which I know you're a huge fan of the cryptos. And it doubles in value, then I guess it was a great investment. But if it was anything else, people can't tell I'm being sarcastic when I'm on the radio here probably, but if it's anything else and it's going down in value, then you got a problem. So okay, let's assume then that the person watching us today has minimum payments and they are starting to go up. So that's like we're heading in the wrong direction, and it may be because interest rates are higher than they were a year ago, which they are, or it may be because my balance has grown. Because that's the other insidious little trick here, right? Hey, you've been really good with your $5,000 authorized limit.
We offer you an increase.
Now you got a $10,000 limit. So now I can spend more and that makes my minimum payment go up. So
exactly. And when some people do that, they're like, okay, I do need to buy food and whatnot. And there's reasons why people grab onto that. It's just it's a double-edged sword.
Yeah, and that's a key point. And I don't want to be insinuating here that, oh, well, if you're using a credit card, you're a bad person, because every single person uses a credit card. And I totally get it. Costs are higher. I've got to buy food, got to pay for this. My car broke down. I got to fix it, whatever. I don't have the cash sitting there. So I understand why we use them. What we're trying to do is get people to take a step back and understand the big picture. So what is your advice? Let's just go right to the practical advice section here. I know we're supposed to do it at the end, but let's just go right to it right now. What is your advice for someone who sees that their minimum payments are starting to go up? And obviously, our first piece of advice would be, well, pay your credit card in full every month. That's what we obviously would like people to do. But if that's not possible,
that ship sailed.
That ship has sailed. Maybe I've been out of work for a bit of time. Maybe there's some other issues. What are some of the things you would recommend someone do when they start to see their minimum payments on their credit cards going up?
Well, first thing I would do is take a look at my spending, really look at the budget. What can I cut out? What can I reduce? Any of the non-discretionary spending, the extras, cut them out. Do you want to go down to your bare bones budget? Even to the point where you're looking to go, okay, how can I supplement things? Do I need to go to a food bank to supplement? A lot of people are using the food bank now because they can't cope with everything. So it's looking at that kind of stuff. So looking at your budget, what can I do to reduce? What can I get reprieve on? And then make sure you're paying your bills on time. If you haven't already, really ensure to do so. If you're at a certain income level, and it does adjust, so it's good to look at it. So you want to contact the energy board to see if they have a plan that can help you either on an ongoing basis or temporarily. You want to, if you can, because you've reduced spending elsewhere, you're making bigger payments towards your bills just to make sure that they are staying on track and on time.
Well, let me piggyback on that point there then. So, it sounds obvious, well, pay your bills on time, but it's even more than that. I'm a big believer, again, it's in the book, I think, where I say pay your bills as often as you get paid. So we already said at the beginning of the show that if you are late on your payment on your credit card, not only are you paying more in interest, but you're getting whacked with the late payment fee and the over limit fee and all the rest of it. And of course, the date you're supposed to pay your credit card is invented by the credit card company. It's the 21st, it's the 13th, it's whatever day they've picked. There's no rhyme or reason to it. Maybe there is, I don't know what it is.
Probably the day they processed your application.
That could be. And for the rest of your life, because you signed the form on the 21st, you're paying it on the 21st. And I guess if your paycheck is on the 21st every month, that's fantastic. But most people get paid twice a month, bi-weekly, weekly, something like that. So I'm a big believer in saying, okay, I get paid every 2 weeks. I'm going to take my paycheck and I'm going to pay all my bills every 2 weeks. And if you do that with your credit card, and even if it is just the minimum payment that you're able to pay, by paying every 2 weeks, you are almost for sure always paying a little bit early, which means therefore you're not going to get whacked with all these over limit fees, extra fees, and so on. So pay your bills on time or even a little bit early if that's what you're able to do. So, okay, so back to what you were saying.
When you're switching to biweekly payments, sometimes your second pay of the month might be after that 21st. So you do want to be mindful of that and maybe front end load or pick a month where you're going to have 3 pays, just so that you're quickly caught up, and it'll help with that.
That's a good point. You got to plan this in advance. You can't just say, okay, well, my full payment is due on the 21st, but my next paycheck is the 23rd, so I'll pay half of it on the 23rd. No, you're already behind. So you're right. It may take 2 or 3 months to kind of get up to speed on it. And you're right. The 3 paycheck month or the 5 paycheck month is one you really want to take advantage of if possible to be getting caught back up. So, okay, what are some other practical tips on dealing with minimum payments?
Another good thing to do, and this might go in line with when you're looking at your budget or your spending, you want to ask yourself how you got to this point. Like how did you get to the point where you're only making minimum payments? What choices did you make? There's a lot of knowledge to be gleaned from looking back and saying, oh, what did I do? And then you want to leave it behind, right? Figure out what happened, make a decision to move forward, and then don't beat yourself up with it. But I think it's important to know, how did I get here? Because that helps you change your future.
Yeah, and if the way I got here was, well, I lost my job, okay, well, I'm working again, let's not focus on the past. But if the answer is, I really love going out for the double cheeseburger 4 times a week, okay, and I'm putting that on my credit card, well, maybe I can buy my own beef and make my own burgers and save a few bucks that way. So some problems you're able to address, some you aren't. And so I agree with you. Don't beat yourself up for the ones that are completely outside of your control. Do what you can on the others. So what are your thoughts? And I'm asking you a philosophical question here, because this is the philosophical section of Debt Free in 30. So are you a believer in, I got an extra $50, should I attack my low debt and get rid of it? So if I got a couple of credit cards, one I owe $50 on, one I owe $1,000 on, should I just blow away the $50 one and get that one done? Or should I be focusing on the higher one? Or like, what's your thought process on what I should be attacking if I got a couple extra bucks?
Right. And actually, I think it's a two-pronged answer, at least. There is a philosophy of get your highest interest paid down first, because that is costing you the most money over time. But there are people who are because it seems unending, it'll never happen, so they get discouraged. If you're someone who needs to see a result, then you want to pay the lowest one first to get it done. You feel good, and then you're moving on. But if you can do a long-term view, then I would say pay down your highest interest first.
Yeah, and I'm in the higher interest camp because mathematically that's the best thing. You're saving more in interest by paying down your credit card that charges you 22% rather than the low interest one that only charges you 12%. However, I do acknowledge what you said, that you've got to also understand how your psychology works. Right. And there are some people who, look, I need rewards. Well, we all do. And knowing that I paid off that little card and it's gone, and now I've only got one other card to worry about, even though mathematically that may not be the best answer, I understand that, okay, it might make sense for you personally. So that's why we let people make their own decisions here. We're all grown-ups. Any other tips that you've got on that particular point, anything we didn't cover?
Well, you do want to look at all your options. I think it's important to have as much knowledge as you can so you can make your decisions. Even if you've talked to a professional to kind of look at your options, it doesn't mean you have to go with it right away. You need to have a plan of attack. This is my first line of attack. This is my second line of attack, and keep going until it works. And I would say you could also reach out to your creditors. There are some that are willing to work with you. They might make an agreement for a payment term. They might decrease your interest rate. It doesn't hurt to call and ask. That's part of the overall strategy, I would say.
So you can actually pick up the phone and call Visa or MasterCard or whoever it is and say, hey, I'm in a bit of a rough spot here. Can you give me a break for a month or two?
Right. And oftentimes the credit cards that we do have, I call it bling, but it comes with perks, right? And your interest rate is higher because it comes with perks. So you can say, well, I don't want the perks. Like, I don't need the travel insurance, or I don't want the scene points or whatever. Maybe some people are going, oh my God, that's crazy. But if you're needing to reduce your interest rate, you get rid of the perks, you get the lowest interest rate card possible, and they're willing to convert to do that. Then it helps you pay down your debt faster. That's
an interesting point, and that had not occurred to me. I guess, and maybe part of that strategy is to say to the lender, look, convert my card from the one with all the perks to the basic bones one. I guess the downside to that would be, from a credit reporting point of view, if you're canceling one card and starting another, you lose the history on the old one, because now it's a new card.
Actually, it's true.
If they're giving you a completely new card. However, if you're now going to save a boatload of interest, then again, I would go for the money. Take the savings.
I don't think getting a different card is going to hit your credit score poorly enough to warrant wanting to pay higher interest.
Yeah, I think, again, I agree with you. I go for the money. I guess what you could say to the bank is, look, can you give me a new card that is the basic Bones one with the lower interest and everything, and then reduce my limit on the old card to $500 so it's still active. It still shows up on my credit history. I'm not losing that, but I'm also not then incurring all the charges. I don't know if they'll do that or not. I don't know if that makes sense, but I think...
Or don't even mention a new card. Just say, how can I take my existing card and reduce the interest rate? Because if they're willing to do it on the current card, then you don't have any credit score issues or anything like that. If they're not willing to do it on the current card, then say, okay, well, can I, then you do the balance transfer kind of things and try to, or those are warning signs of financial difficulty, but that's what we're talking about here. You're in financial difficulty and you need to kind of make an adjustment. But yeah, you want to try to find, sometimes they'll do it on the same card and it's not a new card. And if you need to get a new card, then get a new card.
Yeah. And I always...
Without using the old card.
Right. And you're right. We get into a dangerous area here because balance transfers, you're right, are something I really worry about. Because, I transferred the balance. I got a new card and I transferred my balance on my old card. That's great. Yeah, but now you got two cards. That's right. You got to cancel the old card because now instead of being able to borrow $10,000, I can now borrow $20,000. And that is really fraught with danger. However, I also understand that if that new card has this introductory rate for 6 months, the interest rate is really low. Well, then it does make sense to take it from the old and put it to the new. But you got to stem the bleeding. And you already made the point earlier, which is you got to ask yourself how you got to this point. And again, if the answer was, well, I lost my job, I was out of work for 3 months, but now I'm back to work and I'm getting lots of overtime. Okay, then doing a balance transfer to get caught up kind of makes a lot of sense.
Exactly, because you can throw a lot of money at it. Oftentimes when the ideal balance transfer moment is when you have extra cash flow to throw at the debt, and it helps you pay it down faster by having that balance transfer in the lower interest rate. If you're just doing a balance transfer to give yourself a 6-month reprieve, then you definitely need to be calling a professional to kind of say, hey, what are my options? What do I need to do? There's different levels of warning to watch for.
Right. And if I've got a negative cash flow every month and that's why I'm using my credit cards, okay, well, you got to treat the underlying problem, not try to teach the symptom. Again, easy
Which
for
is
us
either
to say.
Increase your income, decrease your expenses, or both.
That's it. Mathematically, there is nothing else you can do. So these are key things to remember.
You can win the lottery.
You could. We're not advising that. Well, I mean, sure, I advise you.
No, gambling is not advisable.
That's not. I mean,
no matter what they try to
advise you to win the lottery. I just don't advise you to buy lottery tickets because I think that mathematically you're definitely going to lose. So, and again, let me emphasize the point here. What we're doing today is throwing out ideas. We're not telling you to do any of those things. I don't want the comments in YouTube to say, oh, you said I should do a balance transfer. No, I didn't say that at all.
Oh, yeah.
I'm saying consider all your options. For some people, it makes sense. For some people, it would potentially be a disaster. So balance transfers are something that might be a good idea, might be a bad idea. Are there any other things that are obvious bad ideas that, no, you should be ignoring that? You should not be doing that?
Don't ignore the problem, because if you do ignore it, it tends to get worse. Because then you're missing payments or there's increases. So I would say don't take on different debt. When we were talking about the balance transfer, in certain situations where it would make sense, you're canceling the old card. Like, you don't want to take on new debt to try to fix the old and keep the old. So you don't want to.
Well, and just on that point, the solution to debt is not debt.
Right. Exactly.
Taking on more debt to solve old debt. Okay. And yes, I understand what a debt consolidation loan is. I understand if I've got a payday loan or a high interest finance company loan and I can go to my bank at a much lower interest, then yes, mathematically that makes sense. But again, you've said it 2 or 3 times now, you got to cancel the old one if you're replacing it with a new one so that your overall debt level is coming down. That's the whole key to all of this.
Right. And I tend to look at things in a 5-year term. Can I be debt free in 5 years? And if not, then it's taking me too long to pay my debt. What else can I do to become debt free within a 5-year term? That seems to, I don't know why that feels logical to me.
Yeah, and whether that is logical or not, I don't know. I was talking to a lady yesterday who wants to retire in 3 years. Okay, well, so for her, I guess it's a 3-year time horizon then. Right. You would like to be out of debt before you retire. For other people, well, maybe it can be a little longer, a little shorter. But yes, I agree with your general concept. Here's all the money I owe. Here's what my minimum payments are. If I make my minimum payments, how long does it take me to get out of debt? If I make a little bit more than the minimum payments, how long? What is the maximum I can throw at it? And if I'm able to handle it myself over a reasonable period of time, whatever that is, then that's exactly what you should do.
I would also say, looking at knots, I would say don't use your credit card to pay for living expenses. Because once we're in that cycle of using the credit card to pay for living expenses and then paying the credit card, then you can be in a cycle. I mean, I know some people have a points card and they use it so they accumulate the points and then they pay it off. And if that's what's happening, that's great. But if you're in the cycle of minimum payments and things are becoming a debt stress, you need to stop using the credit card for your monthly expenses so that you stop putting debt on the credit card. You want to focus on getting it down and not using it until it's paid off.
Yeah, and I would agree. I think you can use your credit card for whatever you want as long as it is a substitute for cash. So, right. Okay, I go to the store, I get my points, I go home and I pay the card off. Great, because I had the cash in my bank account. Where you get into trouble is when you're using the card as a way to borrow, because the interest rates are obviously wickedly high. So if you're using it as a way to borrow, then that is not a great strategy. So
exactly. And I don't know if I said this already, but don't miss payments.
Yeah.
Like once we've talked about that before, if you miss payments, then you're incurring late fees and interest, and it's just compounding the problem.
So final question then, what if you are at the point now where you are missing payments, you can't make your minimum payments, you're late on payments, and you've done the math and it's going to take you, 17 years to pay off all your debt? That's when you need plan B. Obviously, that's where you and I come in. And that's where you're going to be recommending something like a consumer proposal or a bankruptcy, I assume.
Right. Yeah.
And it's pretty much simple as that. We do these shows to walk people through everything they can do on their own. And if you can deal with it on your own, fantastic. Right. That's what you should do. Yeah. And by taking the steps that you've said, okay, I'm going to cut some expenses. I'm going to, get a part-time job. I'm going to switch from higher interest cards to lower interest cards. I'm going to do all of those different things. And if I can do that and work myself out of debt, fantastic. That's exactly what you should do. But we've got a lot of people, and we're particularly seeing it now because the last 3 years have been somewhat difficult. I don't know if you follow the news at all or not, Maureen, but there's been some stuff happening.
I'm trying to avoid it now.
That's wise. That's wise. Turn it off. Just listen to podcasts. That's my solution. But, there's a lot of people who are way behind as a result of the events of the last 3 years, and there is just no mathematical way that they can catch up. And with interest rates much higher now than they were last year, it's making it even worse. So if you're faced with a 20-year repayment plan, and we're not talking about your mortgage, we're talking about your credit card, then you're probably better off talking to a licensed insolvency trustee, understanding what the options are. When you talk to a licensed insolvency trustee, the upfront chat is free.
That's right.
There is no cost. You do not start paying anything until your procedure has been filed. So if
you don't have to pay someone else to get a referral to us. Right. You just contact us for free.
Yeah, if you're paying someone to refer you to a licensed insolvency trustee, you got scammed. Yeah, it's as simple as that. People, you got scammed. Now, okay, if you're talking to a CPA or a lawyer or something, okay, fine. Most of them aren't scams. But if it's somebody you found on the internet and they don't have any obvious licensing, they're not a licensed insolvency trustee, well, then if you're paying them up front, you clearly got scammed. But the point is, yes, there are options there, and you should avail them of yourselves rather than trying to fight the battle any longer than you need to.
That's right. It's legislation, right? Like the government body said, hey, we need to have legislation that allows people to free themselves from the burden of debt and participate fully in society. So it's something that is, if an honest but unfortunate debtor needs help, that's why we're here, is because that's allowed under legislation. So I think it's really important to understand that it's not a horrible thing to do. It can be some of the the best choice that you do because it frees you to move forward.
Yeah, but this is not something you and I made up. You're right. It's federal law. So if you can't deal with it on your own, there are other options. That's what you should investigate. Excellent. Maureen, I think that is a perfect way to end it. Thank you very much. I'm glad your voice held up for the entire 30 minutes. That's fantastic. You and I will be chatting again. We've got some other topics on the list. So until next time, thanks very much for being here.
Sounds good. Thanks for having me.
Thank you. That was Maureen Parent. You can go to our website at hoys.com and type in Maureen if you'd like to send her an email, particularly if you're in the Ottawa region, then she would be more than happy to meet with you and give you personal advice. That is our show for today. I will put links in the show notes on YouTube to the TransUnion information that we talked about and some other resources for dealing with the debts that we've talked about today. That is our show. Until next week, thanks for listening. I'm Doug Hoys. That was Debt Free in 30.